The era of digital dominance is cracking. We are witnessing a global pivot, a moment where the weight of capital is shifting decisively from the ethereal to the tangible. For years, the market has been intoxicated by the promise of the AI arms race, but that enthusiasm is finally meeting a wall of scrutiny. Tech titans are stumbling under the weight of overbuild concerns, and in their wake, a new regime is emerging. This is not a temporary dip, it is the beginning of a structural regime change where the physical economy is reclaiming its throne from the digital speculative complex. The emergence of value is the story of 2026, and the pivot has only just begun. But let us look at the specific signals that defined this past week to understand the depth of this shift. To navigate this market, you must decode 4 conflicting signals. The State of the Union is deeply bifurcated. In one quadrant, we see the brutal bruising of mega-cap tech as investors demand proof of ROI on AI spend. In another, a complex U.S. macro picture reveals labor is cooling while manufacturing is posting a genuine rebound. Global sentiment is flashing international optimism, specifically in Europe, while the markets brace for a data litmus test that will decide the fate of the soft landing. This tension between labor softening and industrial strength is the hallmark of a healthy, rotating economy rather than a dying one. To see that chasm between the old leadership and the new clearly, we must look at the most dramatic performance gap of the year. The gap was a chasm. This week, we witnessed a staggering 400 basis point spread of pure divergence between the NASDAQ and the Dow Jones. While the NASDAQ retreated by 1.84% on the back of AI disruption risks, the Dow Jones didn't just climb, it shattered the psychological ceiling of 50,000. This is a monumental breakout for the physical economy. It signals that capital is no longer content to sit in high multiple growth stocks promising future disruption. Instead, it is flowing into the small caps and value stocks that have dominated the start of 2026. The 50,000 Dow is the new baseline for a world rediscovering the value of tangible assets. But this market divergence isn't happening in a vacuum, it is being fueled by the shifting gears of the U.S. macro engine. The U.S. macro engine is throwing off sparks of cooling and resilience simultaneously. On one hand, the labor market is flashing caution. ADP added a meager 22,000 private jobs, and JOLTS openings hit their lowest levels since 2020 at 6.5 million. The most provocative signal, however, came from the layoffs. Challenger job cuts hit nearly 108,000, the worst January since 2009. Yet, do not mistake this for a collapse. The ISM Manufacturing Index jumped to 52.6, its first expansionary reading in an entire year. This is a demand-led bounce in the physical economy that provides the perfect counterbalance to labor softening. We are in a risk-rotating environment, not a risk-off one. This domestic cooling is creating a unique opportunity, but the real disinflation story is currently unfolding across the Atlantic. Across the Atlantic, the Eurozone has entered the Goldilocks zone. January's headline inflation figure cooled to a remarkable 1.7%, comfortably below the ECB's 2.0% target. There is nuance here, as core CPI remains slightly higher at 2.2%, but the trend is undeniable. This successful disinflation has sparked a resilient rally, with the Stoxx 600 gaining 1.00% and the CAC 40 surging over 1.8%. Even though retail volumes dipped in December, the underlying Q4 trend remains firm. Euro optimism is currently serving as a vital global stabilizer, proving that disinflation can coexist with economic resilience. Yet, while the continent finds its footing, London remains on a high-stakes monetary knife edge. The United Kingdom is a scene of high-tension monetary drama. The Bank of England's 5-4 split vote to hold rates at 3.75% tells you everything about how precarious this pause truly is. The market is already sniffing out an imminent cut, propelling the FTSE 100 up by 1.43% as officials explicitly signal scope for further easing. The UK is exactly one GDP data point away from a massive policy shift. The cutting cycle is not just a possibility, it is imminent, and the market is already positioning for the move before the official data even hits the tape. The UK is looking for a policy shift, much like Japan, where election fever is meeting a harsh currency reality. Japan presents a fascinating paradox where stock market euphoria is clashing with currency reality. Strong policy optimism following the February 8 election has investors betting on fiscal expansion. This drove the Nikkei up 1.75%, but the real story was the Topix, which surged plus 3.72%, signaling a much broader and more robust market rally than the headline index suggests. However, this rally comes with a hidden cost as the yen remains stuck in the intervention danger zone near 157. Household spending fell 2.6% in December as inflation continues to bite. This is a classic policy optimism rally, but the yen weakness suggests a bill that may come due later. Japan's paradox is clear, but China's recovery is even more divided between two competing realities. The narrative in China remains deeply uneven, a conflict between private resilience and official caution. On the private side, the S&P Global Services PMI hit a 3-month high of 52.3, showing strength in export-oriented sectors. Yet, the official view remains muted, and the markets are feeling the lag. The CSI 300 dropped 1.33% while the Hang Seng fell 3.02%, reflecting a fragility that the private surveys have yet to cure. For now, policy expectations are doing the heavy lifting for Chinese equities, but the rebound will remain fragile until domestic demand catches up with the private sector's optimism. Regional nuances aside, the global scoreboard reveals a singular, undeniable trend. If you look at the global scoreboard, the Great Rotation is written in bold colors. The green blocks are dominated by value and cyclicals. The Dow Jones, the Russell 2000, and the Nikkei are leading the charge as the primary beneficiaries of the new regime. Conversely, the red blocks tell the story of the rotation's victims. The NASDAQ and the Hang Seng are the clear laggards. Investors are de-risking away from overextended tech multiples and uneven regional recoveries. This matrix confirms that the leadership of the market has fundamentally changed hands from digital speculation to physical reality. The scoreboard is locked for now, but the coming super week threatens to upend every position on the field. We are heading into a super week that will serve as the ultimate litmus test for the global economy. The calendar is a volatility pressure cooker. It begins with the U.S. jobs and unemployment report on Wednesday, alongside critical China inflation data. Thursday brings the preliminary Q4 UK GDP, a binary moment for the Bank of England. But Friday's consumer price index is the main event. The delay of the jobs report has packed these high-velocity events into a few short days. This convergence of data will determine whether the soft landing narrative survives the month or collapses under its own weight. This isn't just a calendar, it is a series of binary pivot points that will define the narrative for the rest of February. The upcoming data prints are not just numbers, they are verdicts. On the labor front, a strong jobs print will reignite higher for longer anxieties, while a weak print will fuel recessionary slowdown fears. The CPI print on Friday is the ultimate volatility button. A hot CPI will hit long-duration assets and AI multiples with renewed force, punishing those who stayed in tech too long. The only path that accelerates the soft landing trade and sustains this broader rotation is a cool CPI print. Friday is the moment of truth for the Great Rotation. If the data misses, we face structural threats that could turn a healthy rotation into a broader market rout. Beyond the immediate data, three structural threats loom. First is the tech capitulation debate. Is AI capital expenditure visionary or a bubble? Another leg down in mega caps could create a massive passive indexing drag. Because tech is so heavily weighted, its failure could mask the genuine strength of the physical economy, dragging down the entire index. Second is the UK GDP shock. A weak reading would force aggressive rate cuts. Finally, China's inflation stakes will determine if we see meaningful stimulus or more stagnation. We must watch these global crosscurrents, as they have the power to derail the rotation entirely. Navigating these threats requires a clear-eyed view of the ultimate investment bottom line. The strategic takeaway is clear: the economy is cooling but not collapsing. We have three pillars to watch. First, the continuation of the rotation into value and small caps. Second, the dual litmus test of U.S. jobs and CPI. Third, the regional pivots signaled by global crosscurrents in the UK and China. Investors must understand that the volatility we are seeing is not a sign of failure, it is the price of admission during a structural pivot. The baton has been passed from tech to the physical economy, and that transition will be anything but quiet. To move from narrative to execution, we must ground ourselves in the technical levels that define our current reality. As we close, I direct your attention to the ground truth in the appendix. We are tracking the 50,000 Dow breakout as our primary psychological marker for the physical economy. In the US, the ISM manufacturing jump to 52.6 remains our anchor for expansion, while jolts at 6.5 million marks a significant cooling from previous years. Internationally, the 1.7% Eurozone CPI and the 157 yen intervention danger zone are the levels that will dictate central bank behavior. These numbers are the foundation of the narrative we have discussed today. These are the cold facts, however, they must be viewed through the lens of proper institutional risk management. This presentation is for informational purposes only and does not constitute financial advice. Past performance is not indicative of future results. Market data is current as of February 6, 2026. Please consult the full disclaimer and source list, including data from the BLS, ADP, ISM, ECB, and the Bank of England, for your own modeling and compliance requirements. In a market this divided, the only certainty is change. The Great Rotation is no longer a forecast, it is the floor upon which the next decade of capital will be built. Thanks for watching. If you found this useful, please like the video, share it with your network, and subscribe to the channel. You can also claim the full slide deck for free.